Okay. So this one, behavioral biases. So investment involves a lot of psychology. If you want to make money in the market, a lot of psychology is there. Human psychology and how it influences your investment decisions. Decisions. Now, investors, all of them will not think rationally. When they make money, they feel happy. When they lose money, they feel very depressed. And they start blaming either themselves or the advisor, all these things. Okay, so for example, like if you buy a stock or a fund or a bond, $100, if it goes to $110, suppose two people are there. Now, one person may think, if I don't sell at $110, maybe I lose this game. So he is looking at short-term satisfaction. Short-term satisfaction. Because he's afraid it will again come back to 100, or he may fear it may go to 95. But another person, for the same situation, he will say, I don't need money. I don't mind the fluctuation. I will keep it for 2 years or 3 years. That is the decision he has taken at this point. Neither he nor this guy knows how it will behave going forward. The future is not known in the markets. Now, this person is thinking of long-term benefit, a long-term benefit. It may go to 125, and maybe he is right, or it may go to, or it may stay 110, or it may go to 95. Okay. Now, if it goes to 125, he is rewarded. If it goes 110, okay, maybe it fluctuated, but he is not in a loss still. And if it comes to 95, not that he has lost, but he will think keeping another maybe for another 2 more years or 3 more years like that. So some people who have long-term vision, long-term thinking, they are not worried too much by this fluctuation. They don't need the money, and they are willing for larger gains. In markets, if you want to make money, you have to look at larger gains. It's not the smaller gains. But most people don't do this process, but they go for this one. They will sell it and they want to buy something else. Now, if they sell it, it will go to 120, then he will not buy because it's already gone up. He wants to put in something. Now, that is because of the psychology of the person. He's afraid that the price will come down. Or another situation, bought 100, it went to 90. Now, a long-term person may think like, okay, I will give it time, or maybe he will put more money. He will average the cost. Either here, or he will think that maybe the news is bad, like about that particular instrument. Maybe it will come to 70. I will buy it. Or I'll buy more. So when you invest in the markets, putting money, all these investment decisions have to be made. Now, whether you make it as an investor or your advisor makes it, both are humans. And no humans have the same psychology. They have different psychology. If it is my money, I may think differently. If it is client's money, I may think differently. So you need to, when you are making a portfolio recommendation to the client, first understand the client's psychology. A client may exhibit many these biases. Biases means not rational ones. Okay, you have to educate him, of course, or you have to basically like, okay, it's not easy to educate from my experience. It is not easy to educate, and you will see interesting situations as you go through it. And you know the client may be disappointed, and so the what they call the risk tolerance has to be revisited again and again, because the investor who's happy in the first time when he made money may be disappointed when it goes. So you have to see what are the big outcomes, and then you have to advise them how you should look about a loss. You should educate the client how you should look at a loss. Loss was not that you lost the battle or something like that. It is because in the market there are so many factors which are not under our control. Maybe something has come which was not expected. So this is a learning for both investors and the advisors. So in this book they use the word FMP. FMP means financial market participants. Financial market participants. Now this is applicable not only for retail clients, even institutions. There are big institutions which have done terrible mistakes, maybe like some hedge funds, a Deutsche Bank or Credit Suisse. They have resulted in big losses for their companies, big losses. You take, for example, especially in bull markets, people get overconfident. It will not come down, keep on buying, keep on buying. There is, say, pressure in banks to make more and more fees, or brokers or fund managers, their bonuses. So they will keep going, buying, because money is made easily. But then when the market turns, this overconfidence causes a lot of damage to the clients, a lot of damage to the markets. Some firms, some companies like Lehman Brothers, they are not there now. So this is a part of risk management. This is part of risk management. Now, this is not something which the regulators like SEC or in India, so this is to be managed within the firm, and firms who want to, or investors who want to survive long, they should know this sometimes. They should know what are the mistakes. So this is the brief overview. So you have two types of behavioral biases. Two types. One are cognitive errors. Again, we're using the word cognitive. See, investment involves brain. You need to make decisions. It is not like your regular job or a business. These are decisions about the future, which you don't know exactly how they happen, but they are rewarding. And then emotional biases. So these are two types: cognitive errors and emotional biases. Now, emotional biases are more of psychology. Difficult to change. See, some people are basically, they're very daring. They can take big risks. Some people are very timid. So these are based on how the brain of each individual works. But cognitive errors can be corrected or eliminated through better information, education, advice. If you have more education or more information about the mistakes humans can make, cognitive errors you can correct. Emotional things are more of psychology, they're more difficult to change. But they both play a big role in financial decisions. I just want to say, you can lose money in the markets in, say, 4 ways from practice. One is poor diversification. If you want to invest 100,000, first don't ask what is the return I'm going to get. First say, like, I will first split this money into 4 or 5 parts, 20,000, 25,000 like that. Okay. That itself is first step. You are cutting the risk of losing on the entire thing. So always split it to 4 or 5 because you don't know which one will do well. Okay. You may have opinions. You might think that US may do well, China may do well, India may do well, but you're not sure. So always you split the first you make it into diversification where there is a correlation is less. Correlation is low. That's why you put some money in equity, some in fixed income. You don't want all the 100,000 to go down if market is bad. Second one is market can fool you. Market can fool you. However big you are, maybe you are a big institution. Many big institutions were fooled. They may use algorithms. They may have very smart analysts or portfolio managers, but market can fool all of them. Because market is like a moving football post. It is not going to stay. It will keep on changing. Third one is, your mind can fool you. Your means is an investor or is advisor or whatever, fund manager, whoever it is. Means your means basically the market participant. Despite your research and all these things, see, ultimately the decision. Suppose you want to buy in a particular market or a particular fund, that's a decision you have made. You have studied, you have read somewhere, you have made your financial model, you have said all these things, and you think it is good. And you missed out maybe certain things, or certain things have come after you invested, which you didn't expect. So you are responsible for it. Your mind can fool. Okay. And the fourth one is, you can say, bad luck. That is information asymmetry. I can say information asymmetry. So these are the 4 ways. These are part of risk management. These 4 ways you can use ML. Okay. Or maybe you don't give sufficient time.